So here's part 2 of our property insurance, chapter 22. So in the last video, I talked about just kind of how property insurance works. And then today we're going to talk more specifically about homeowners insurance and auto insurance. So with homeowners insurance, there are like a lot of different packages, quote unquote, that you could choose from. And our book calls these like HO1, HO2, HO3, and so on and so forth. Most homeowners, this is according to our book, most homeowners get an HO3 or an HO5 policy. So these things just cover different things. The one we're going to be talking about today is HO3. I'll do an example for that one in just a minute here. So, typically homeowners insurance, like protects against fire, lightning, windstorms, hail, civil commotion, and aircraft crashing into your property. And then they also have typically liability insurance if somebody like visits your house and is hurt while they're there. So that would protect against that. But most homeowners insurance don't insure against like floods, landslides, and earthquakes. For example, I think I talked about this in the last video, but like in Selby, especially over on the east side, a lot of the basements in homes flood because of the water table being high there, and like it used to be kind of swampy ground. So, their homeowners insurance may not protect against flood unless they have specified that they want to be protected against that. Now, will a company take you to protect you against flood insurance if they know that there's high risk of flood, or will they? So for example, I guess what I'm asking is, like, last year when there was all that flooding, would people be able to get insurance for that flood damage that happened if they didn't have flood coverage on their property insurance? The answer would be no. So those people that had flood insurance before were covered. If they didn't, their insurance company was not obligated to pay anything. So, that's kind of a thing. Like here, we don't get earthquakes, so why would you pay extra and be overinsured for earthquakes? Or like a landslide, or we don't have landslides here. Something that might happen is like a windstorm, I guess would be, a tornado would classify under that, so you'd probably be protected here from like a windstorm. I believe last year when I looked, I think Idaho might have the cheapest property insurance rates just because they don't have tornadoes, they don't have earthquakes, typically no floods there, and then obviously they don't have any landslides there. So Idaho would be pretty low. A place that might be really high, I think, like down on the tip of Florida, insurance rates are very high, and I think in Hawaii also. So you might ask, well, why is that? When you start thinking about, okay, in Hawaii, earthquakes happen, there's volcanoes, they could flood very easily since they're islands, they're like tropical. Same with Florida, down in the Keys, like flooding is normal, hurricane season is normal there. And so those are things that really jack those property insurance rates pretty high. So those are just a few things that you should be thinking about if you live in an area or you're building a house in an area or buying one where it floods a lot, then you probably want to add some sort of flood protection on your insurance plan. A few things that you might want to look at if you're buying a homeowner's policy, look to see if you are protected against, for example, like water damage from backed up sewers and drains. And this is interesting. I actually had my sewer drain or my like sewer pipe plug up twice in the last month. And if you're listening to this is one of the answers to your Google form. So I hope that you watch a video before you filled out the form. So there's your free point. My sewer drain plugged twice in the last month, and I had to pay somebody twice to come out and fix it. They had to like bring their Roto-Rooter in and go down through my system to unplug it, and they said my pipes are very, very old because no one lived in this house for many years. And also they found some tree roots in some of the old pipe down there. So, old house problems. But anyway, you might just want to check on your homeowner's policy, things like, will my house be protected if a tree falls on it? Or if I have so much snow that it caves in the roof? Or if there's an explosion, would it cover? Something like that. An explosion, okay, that sounds pretty crazy, but if we're really talking about it, it's like if your hot water heater blows up or if your heating system malfunctions, that could be a very common cause of an explosion in a home. Or like if you have a fireplace, does your homeowner's policy cover against like smoke damage? So when I was applying for my homeowner's insurance on my new house, I had to answer a bunch of questions like, how long ago was the roof replaced? And that helps. It's a newer roof, so that definitely helped. My premium went down from that. What is the square footage of your home? How many bathrooms do you have? Just questions like that is what they ask on there. So, one more thing before we move on a little bit. Your book on page 467, if you're following along with me, 467, you want to look at, are you replacing your home? Are you insuring your home based on the value or based on replacement cost? So if you paid $200,000 for your home and the land it sits on, do you need to get insurance for $200,000 worth of property? And well, first of all, that $200,000 included the land your house sits on. So you probably are not going to be insuring for that whole amount. We kind of talked about this when we talked about like value of a rental property a few chapters ago when we were still in school all together. Anyway, so for example, I paid $30,000 for my home, but I also have the entire lot that it sits on. So is my home itself really worth $30,000, like the insurance costs? Probably not. But if I need to replace it, that's where our costs are going to be a little high. If you're looking at the value, that's looking at how much it cost to build it in the first place, or what it's appraised at. And then you would go from there. So those are two terms that we talked about last week. Okay, we also have discounts, so we'll talk about those too. So examples like if your home is less than 10 years old, you might get a discount. If you have a burglar alarm and deadbolts and a smoke alarm, you might get discounts on that. And I believe that is true for my home because I do have 2 working smoke alarms, and maybe other things that like I got discounted for that. So that's really nice. Okay, moving on. We have an example here. You buy a homeowner 3 basic policy in the amount of $120,000. Calculate your annual premium using table 22-1. This is on page 468 in your book if you are working on your homework and you need to look at that table. So this is what we're assuming. First of all, your home is classified in premium group 2. So we come up here and that means that it's classified right here. And we look for a coverage for dwelling too if you want to just make a note of that. We're at $120,000. We're assuming also that you get a 5% discount for having a burglar alarm. You have a new home discount. You get a 2% discount for having a smoke alarm. And then you pay an extra $45 for liability coverage. This new home discount is supposed to be 12%. I forgot to put that in there. So there we go. Okay. So what should our annual premium be just based on the $120,000 and then premium group 2? Well, we come across here with $120,000 and we can stop right here and say, well, it's going to be $351. Now remember, this is annual premium. Home insurance is actually in this table not too expensive. So that's kind of nice. So with these discounts, we apply them all separately to that premium amount. So for example, our 5% discount, this is part B. I'm just going to write this right there. 5% discount on this is going to be $17.55. So we subtract our discount and get $333.45. Our new home discount's 12%, so we apply that 12% to the $333 times 12 times that 12%. So if I come over here, 333.45 times 12% is $40.01. And if you want me to show this work here, this is just 333.45 times 12%. Okay. Same for B. This is 351 times 5% if you're wanting to see a good example on how to do these. Okay, we subtract that C, that 12% discount, and we get $293.44. Okay, for part D, we have a 2% discount for having a smoke alarm. So we're going to multiply that $293.44 times 12%. Excuse me, 2%. Get that erased there. Okay, 2%. And that is $5.87. And you might say, why in the world does that matter? I don't care about $5. I don't care if I have to pay it every month. Well, every little discount helps. Okay, and then our new subtotal is $287.57. Okay, this last part is just a little bit different because we pay an extra $45 for liability coverage. Remember, liability is like if somebody comes to your house and trips on your step and breaks their arm, that liability coverage is going to help protect you from whatever might arise there. So we actually have to add this on because we're paying extra $45, and our total then would be $332.57. We always round these to the nearest dollar, so this would actually round to $333. And there's our answer. That's our annual premium. Okay. Typically, this is wrapped into an escrow account if the homeowner has a mortgage, and mine is. So every month I make a little bit of that payment, and then my mortgage company pays that whole premium based on my payments every month to them. So remember, in that escrow account, it's typically just a mortgage payment plus your property insurance or homeowner's insurance plus your property taxes. Okay. I have one more example here, and then we're going to talk about some auto coverage. So Jeremy and Simone Silverman own a 24-unit apartment complex. Use the table above to calculate their annual premium based on these 5 things. So this is typical for apartment buildings, and this is per $1,000 of a replacement cost. So you're kind of looking at, if you look up here at these costs, you're like, oh, it's all less than $6, and that's not actually true because it's based on $1,000 of that cost. So what we need to do is figure out the rate that they're going to be paying per $1,000. So looking at part A here, they're in premium group 4, so they're going to fit in this very first section. They also have masonry construction, which is like brick. And then we also have a 24-unit apartment complex. So we're looking at this section. So for masonry construction, under that first group, for 24 units, our rate is $2.20. And this is per $1,000 of replacement costs. So to figure out our premium, we have to take our replacement cost, which is $820,000, divide this by $1,000 because this rate is per 1,000. Okay, so we divide this by $1,000, we get 820. And then we need to multiply this by we'll just put parentheses, by that rate, which is 220. Okay, when we multiply those together, we get $1,804. Okay, we have a few discounts here, like our $1,000 deductible. We need to calculate a discount for that. We find that when we look up here at the bottom of this chart because it does say the rates are for a $500 deductible. So we subtract 4% of this total, minus 4%, and that 4% we're multiplying by that 1804. Okay, 1804 times 4%, that is $72.16. And we get $17.31.84. We're not quite done because we have $1 million of liability coverage, and you would need that if you have tenants in your building, okay? And then we figure that one, also looking at the bottom of this chart, increase liability coverage to $1 million, pay an extra 20 cents per 1,000 of replacement cost. Remember, per 1,000 is the same as this guy right there. So we're going to take our 820 times the 20 cents right there. And we have to actually add this amount onto our total because we're paying extra for the liability. And that is $164 that we add on to that. So our total is $1,895.84. We round to the nearest dollar always. So our total is $1,896. Okay. Moving on to auto coverage. So we have a few different things included in your auto coverage, and typically they're going to, like, if you call your auto insurance company, they're going to say your coverage is 25, 50, 20. Okay, what does that mean? Well, that means that your policy will be paying $25,000 up to $25,000 for bodily injury per person. So if you have like 3 people in your car, this is per person, that would be $75,000, paying up to that amount. Up to $50,000 for bodily injury to all people. And then $20,000 would be any property damage. So say you like ran over a curb, you're trying to park, ran over a curb and hit a building, that $20,000 would be going to whoever owns that building or whatever that they would need there. And remember, these are up to for all of these. This is, liability coverage is stated this way. Okay, so typically states require owners to carry like a minimum amount of liability insurance. It just kind of depends on the state if they're going to like make that charge against the owner of the vehicle or the driver. So I remember a few times in high school I'd have to drive my friend's car somewhere, and say even if my friend was in the car, it's not mine, and so the insurance on the car for the owner in South Dakota would be covering that. So could I drive uninsured? Well, if I have a driver's license and I have some sort of vehicle, I should have some sort of insurance. For example, a couple summers ago, this kid backed into my car. There's a few issues with this, though. It wasn't just that he backed into my car, but so it caused quite a lot of damage. Like I couldn't even open my driver's side door from that side. Anyway, long story short, he was driving a ranch vehicle on a ranch that we both worked at, and he claimed he did not have auto insurance. So who is at fault there, the owner of the vehicle or the kid? Well, technically the kid should have been responsible for that, not the owner of the vehicle. The ranch had liability, and we sorted it all out. So that was just kind of an interesting situation there. So some states do require no fault insurance. So reimbursement of bodily injury will be paid regardless who's at fault. So even if you were the one that hit the little old lady walking across the street, if you were at fault, obviously you would have to pay. But if someone else hit you and their car was damaged, so a parking lot or something, someone else hit you, their car was damaged, yours was not. If it's like a backing up situation, there's so many different things that could go on in these auto insurance deals. Some states will just say, it doesn't matter who is at fault, we're just going to pay that. And that is the no fault insurance if you're taking some notes. Okay, doesn't matter who is at fault. They're still going to pay. Okay, just wrapping up here, if you say your parents, probably most of you do not own your own vehicles or you don't have your auto insurance registered under you. If you pay your own auto insurance, awesome, good for you, let me know. I actually didn't have to start paying until I bought my own vehicle. My parents were really nice, so they paid it for me through most of college and all of high school. Companies typically will give you a multi-car discount. They also give good grades discount if you are in high school or college, and maybe even you're a year after college. If you don't go to college, probably a year after high school. They do give different discounts for things. So we can't really calculate an auto insurance premium because there are so many different things that we could, take a discount on or whatever. So basically, just make sure that you're covered well enough. Ask for a breakdown of your coverage. Ask questions. My parents made me call and get my own auto insurance, and I got to pick the company I got it through when I bought my car. And so, yeah, just make sure that you ask a lot of questions and understand your insurance agent should be able to answer whatever questions that you have for that. So make sure that you get that homework done and let me know if you have any questions.